Good morning, everybody. Welcome back to Schwab Coaching for the Wednesday edition of Trader Talk in today's market. I am your host, Kevin Horner, joining you from Denver, Colorado. Pleased, as always, to be joined by friend and fellow coach Brent Moores this morning. Good morning, Brent. How you doing?
I'm doing good, Kevin. As usual, I'm happy to be on with you this morning. So looking forward to talking about the markets here.
Well, I always appreciate having you on a Wednesday. We will get to plenty of commentary, bunch of charts as we always do. This morning, we've got JB in the chat. So say hi to James Boyd, if you don't mind, everybody. He's going to keep an eye on things for Brent and me, and we'll, of course, do the same because commonly you guys have some good comments, questions that we want to address in the show. We will be happy to do that where we can, so feel free to post in there throughout. We go about 45 minutes in total, everybody. Additionally, we would love your follow on X if you're not already doing so. Individually, we're available at James Boyd CS, at Brent Moores CS, and at Kevin Horner CS. We try to post there on X periodically throughout the week. I'm a fan of trying to bring charts that are kind of notable or intriguing to the table there. And I know Brent is big on bringing in data and things that we got to be keeping an eye on as well. But it's a good way to engage with us outside of the class. So if you don't mind, we'd love your follow there. And of course, if today's conversation goes well for you, you get what you're looking for from us, we'd really appreciate a thumbs up on the screen here right beneath the presentation window. That helps us out as well. With that, let's jump to our disclosure so that we can get into the good stuff for you all. So I'll remind you, of course, that our discussion here is always informational and educational exclusively, meaning simply we do not make recommendations here. Remember, any expression of opinion is subject to change without notice. Of course, we talk technical analysis quite a bit. This is something where we really want to provide you the snapshot viewpoint, if you will, of the market's price action. We look at a bunch of charts and discuss concepts and strategies. Technicians, traders who use charts, they might choose to employ when they are trading. But it's important to remember that technical analysis is simply one piece of that puzzle. We do not encourage you to make decisions exclusively off technicals. Beyond that, we want to get you to a review of our agenda, which of course starts in that broad view. We hit you up with the major indices. We're going to look at the S&P 500, the NASDAQ 100, and of course the Russell 2000. We've also got some industry groups to touch on today. A number of key downgrades that Brent and I found to be kind of notable. So we're going to look at a couple of industry groups as well. So with that, why don't we jump into the S&P 500, which I've been really watching, Brent, as we continue to maintain this real rising and yet coming to an apex channel, right? I mean, the trend we've been in here has been really strong in terms of price action, but it is kind of standing out to me nonetheless that while we continue to hang out at these upper elevated over 6,000 level on the SPX, the momentum of late has kind of started to wane a little bit. Is that something you're keeping an eye on or something you've noted as well?
Well, yeah, yeah, Kev, it is. We are, and you can see that. I mean, you can see that in the RSI. I mean, we're kind of hanging around that 60 level, which indicates, look, you're not there unless you've had a decent trend, and we've had that. We're above that 20-day moving average. Little pullback, some smaller candles, and the thing is, for the rest of the year, there's really not a whole lot. I mean, we have CPI this morning. We had CPI this morning about 1 hour ago or something like that. We've got PPI tomorrow, but usually that's a little bit less of a mover perhaps than the CPI report. But there's not a lot the rest of this year, to be honest, in terms of like economic reports coming out. And, we don't know, that I can think of, huge earnings reports the rest of the way. And so we may see less. I would think we may see a little less in terms of big earth-shaking things that can move the market that much. So I'm wondering if we can just kind of hang out in this range a little bit for a while, and then come the new year, we'll see what happens when new reports come out, and we have a new outlook in the market at that point. But Yeah, it's just not going that far very quick right now.
Yeah, I think I really like what you said there. Ultimately, lacking a catalyst at this point.
Yeah.
Today, CPI, tomorrow, PPI being the last two real opportunities for market relevant, market moving data per se, might leave us with a little bit of sideways action here as we dabble between about 6,000 and 6,100, which is the range we've kind of just set recently. Would you be at all surprised if the remaining, what we're looking at here, 20 days on the calendar leaves us with about 12 overall market days, I think, something like that, between now and the end of the year. Granted, I'm just I didn't count them out, unfortunately, but it sounds close to that. The point being, lacking a catalyst, Brent, we could just simply meander and hopefully maintain the 20-day moving average for those short-term traders.
Yeah, that would not be unexpected at all here. So, who knows? I can't predict the market exactly what it's going to do. And, traditionally end of the year has been relatively strong in the market for the market. But, there's just not that much that, no, of course, I'm not saying anything geopolitical. Obviously, we had all this news on Syria lately. There's always something that can unexpectedly affect the markets. And I just don't see a whole lot right now that's expected in the knowns. There's always the unknowns, but in terms of the knowns, I don't see that much affecting the market significantly at this point.
Yeah, and we should also mention, Luke points it out here, we do also have PCE coming as a heads up. I think, if I'm not mistaken, that one is actually due for November, due tomorrow, the 12th. And I think that'll coincide with the PPI report. But nonetheless, I think the story remains the same, Brent. Yes, we're going to be paying attention to those inflationary details, but given what we have been rallying on as we head towards the end of the year, I have to wonder if we're going to just simply maintain the level of overall bullishness that we've had since the results of the election.
Yeah, I mean, I would agree. And, who knows? This is from a technical standpoint. Of course, you hear a lot of people who are concerned, and I've posted quite a bit of stuff on Twitter or X about this, about market valuations, about how high market valuations are in terms of, say, the S&P 500 in relationship to their PE ratio, in terms of their forward PE ratio, in terms of other valuation ratios, concerns about that. But the market doesn't seem to be budging out of its bullish stance at this point.
Yeah, I tend to agree, and we don't like to fight trend.
Yep.
As technicians, trend traders, we go with what's working. We try not to fight against that as best as we can. I know that in certain circumstances, that's very difficult if you're not believing in what you're seeing. But that's why one of my favorite trader axioms, Brent, is the idea that we trade what we see, not what we think should be happening. That tends to keep us, at least in the short term, perhaps on the right side of things for the most part. But as usual, that does involve discipline and a process and an approach that makes sense for all of us individually. So a little bit more of the same with what we have received of late with the S&P. Last note on it, we are trading through yesterday's high as we speak. So if we were to drill this into the 5-minute ledge here, everybody, the oval I've got, I'm just going to go ahead and remove that for our visuals, but we gapped R1. This is actually a fantastic open on the S&P for us today on the heels of that report. So gapping R1, not just holding the pivot, but gapping R1 makes the pivot level, or pardon me, R1 the pivot for the day for a short-term trader. So eyeballing that 6,055 area for short-term support. Any other details you'd like to apply here, Brent, as it relates to the S&P today?
No, I don't think so. Let's move. We got a lot to talk about, Kevin. So let's move on. How about?
You got it. Well, there's the NASDAQ doing the same thing, breaking that very brief downtrend. When I say downtrend, really what we're talking about looks like a bit of a brief bull flag, doesn't it, Brent? Resolved quite quickly.
Yeah, that is, and that we've seen that a fair amount, the flagging, but in this case, it was just a really short one. But up today, we'll see. But the general trend has been very strong, and we're well above that 20-day moving average.
And if we note here, everybody, a couple of different layers of support. I have the support line drawn in at the breakout level, but we did test yesterday's lows, got into the gap, and were bought up. And then today's report gave you a little bit of lift. And I'd venture to guess, given the open we see here, that we would be above the pivot. Let's see if the same thing, and not just the pivot, but R1 here as well. So an excellent open on the NASDAQ 100. Looking for some continuation again. Short-term bullishness would certainly be great, given, it's really, you can take away just some of the thought process about how strong this market has been when you undergo a 2-day very minimal pullback and everybody's like, yeah, okay, we're right back where we were. There's not a whole lot of negativity at this point in time.
Yeah.
Yet I still can't help but just remind myself that we are turning the corner to a new year very quickly.
Right. One other thing I would point out is some of these mega caps are really driving it right now. I mean, if you look at Meta, Google, Apple, Kev, like they've really taken off. And so you see the NASDAQ outperforming. You even see the S&P 500 outperforming versus the S&P 500 equal weight. Now, the S&P 500 equal weight, maybe you could pull that up real quick here.
You got it.
It's still strong. I mean, we still have a trend, but look at this. We've had how many red candles did we have in a row there?
Like 6, 7.
Now compare that to the S&P 500 or compare that to the NASDAQ, and what you see is that it's not near the pullback. And so that tells me some of the larger cap companies are the ones that are outperforming. And I happen to know, like if you look at Alphabet, or Apple, or I think Meta, what you're seeing is those have really kind of outperformed. So they're the ones kind of carrying the large caps, the mega caps up, whereas your kind of more average large cap still doing okay, but not to near the extent.
Yeah, that's a good point. And yet, it's funny because if you look at those, it's not like they're diverging from one another. Both are showing bullish trends.
Yes.
One having retreated just to support, that being the equal weight, and then the SPX itself hasn't really given any give back here. So the enthusiasm remains positive, and when we continue to see that there has not been a whole lot of profit taking this month, really, it's been kind of limited in scope. So it feels like everybody's very excited to continue pushing the S&P, pushing the NASDAQ 100 towards the end of the year. Obviously, the final couple of weeks here are going to be very interesting to keep an eye on, which, we're going to be here for a majority of that, by the way, but we will be having a little bit of downtime, dark period as we get towards Christmas. So just be aware that some of the set schedule will be altered for us here on the YouTube coaching channel. I encourage you to take a look in that week of December, for example, where things go dark for a little bit. So just as a heads up and a precursor for all of you. So beyond that, Brent, let's move into the Russell. Let's look at how small caps are reacting here. The Russell up 2/3%, kind of resembling that pullback to the SPXEW, the equal weight on the S&P 500. But this is a nice higher higher low, potentially if we can maintain the 20 right here.
It is. Now, we do have a little bit of a divergence on that RSI, Kevin. And now that doesn't mean, we're changing, this thing's going to fall apart or anything. But we do have that lower high on that versus where the index itself is on there. But hey, look, anytime you're holding that 20-day, things aren't going too bad for you.
Yeah, it's really hard to complain on any position that's maintaining the 20-day moving average, because that really tells you the strength is in the short run, and you've been able to manage positions along the way utilizing that speedy moving average. And really the 20-day for a lot of traders is the fastest moving average with which they have comfort. So when we get runs working with the 20-day, it can really imply momentum. It'd be intriguing and certainly be positive if we could maintain this level. The rally you're getting today, up 2/3%. I should point out we've had yields fall slightly today. We have, we're in a really important spot, Brent. Today's number on the CPI pushed the CME Fed tool expectations for the December rate cut up to 96% now.
Yeah.
And that has shifted pretty dramatically. As I was looking at it earlier, the change has been from just a week ago, we were at 78%, and here we are at 96, just based on the recent data.
Yeah, and in fact, I kind of asked a question on X the other day, hey, at this point, is the Fed rate cut, a 25 basis point cut, kind of baked in regardless of CPI? Well, regardless of whether it was baked in or not, at this point, it seems like, do they have permission, so to speak, to cut, given the CPI numbers, PPI, and I know somebody mentioned the PCE numbers coming up, which, technically the PCE is the preferred inflation gauge for the Fed, but it tends to be less of a shocker in terms of their numbers than what the CPI will give sometimes. So
sure.
It's looking like it's happening here. Now, it's probably important to just remember, just because the Fed cuts short-term rates, it doesn't necessarily mean long-term rates are coming down. Now, long-term rates have eased a little bit here, and you can see that on this graph. This is the 10-year. But keep in mind, the big run that we had up from, September to November on the 10-year coincided occurred right after we had the big drop in the short-term rate.
Yep.
So just because the Fed is kind of continuing on this path of cutting short-term rates, it doesn't necessarily mean your mortgage rates are going to go down, or the 10-year, the long end of the curve is going to come down necessarily either. But I think we have seen a little easing here on this 10-year of late.
We have, and you're right. We saw more or less, I think it was September 11th where we had the Fed decision. And then the last time we had a low in the yield was like the 17th. So within a week, we got a sell the news type situation here where they cut rates, got exactly what we expected, and rates rallied aggressively, 90 plus basis points from this 3.6 zone up to 4.5. Pretty aggressive. And yet the S&P 500, the NASDAQ, here we have, managed to make new highs in both.
Yeah.
So from to a certain extent, we've been collectively digesting the higher rates as not as negative as may have been expected. So we are at a crux spot here, at least as it relates to the yield, sitting at around 4.2 right now on the 10-year. If we're looking for some additional lift in the Russell and some of those central industry groups that are sensitive to interest rate movements, then a break down from here could be opportunistic. But this is a pretty important spot. So I think we just want to keep an eye on what's happening at this area.
Yeah. And, Kevin, I don't want to, I don't want to jump the gun here too much, but, you may think, well, hey, if mortgage rates have eased a little bit, then, home builders and stuff are necessarily going to take off, or, that's not necessarily the case here on that. And so we can talk about that later if you want. But also, I thought I'd point out, if I don't mean to throw you a big curveball here, but if you want to see like interest rates, or mortgage rates, for example, on the Thinkorswim platform, you can do it. You can go to the Analyze tab and click on the economic data. If you click on that economic data and you click on the little home button to the right of that, and you'll see it says there's different things. There's interest rates in the first upper left column there. Yeah, right there. And then down there's going to be mortgage rates, and it's near the bottom, about 4 from the bottom there. If you click on that, you can click on the very top one, average 30-year fixed rate in the U.S., and then that's going to give you, now it zooms out to this, from 1970 or something like that. So you're going to want to zoom in on this chart a little bit, definitely. And you can see, I was a kid during some of those time periods when, mortgage rates were, I don't know, well above 10% or whatever. Fortunately, I didn't have to buy a house at that point, but but you can see we kind of have almost a, normally I would not recommend doing technical analysis on a mortgage rate chart or anything like that, but kind of almost a head and shoulders pattern here on this there, but you can see we have dropped. So just FYI, if you ever want to find on the Thinkorswim platform, interest rates, mortgage rates, yield curves, stuff like that, this is a place that you can do it. There's other economic data too, but
that was a great little teaching moment, Brent, because I often forget that we have access to all this detail. That is a wonderful reminder. And we can always anytime you find yourself here and in the chart a little lost and you want to get back to where you were, that home button will get you there.
Yes.
But again, lots and lots of data available here. If you wanted to spend hours, you could peruse every one of these and get a little bit of clarity on a number of key pieces of data that you might be wanting to maintain or monitor. This is pretty good stuff, Brent. Thanks.
Yeah, and just one thing to remember, this chart is not, these charts here aren't compatible with the other charts. So if you put in like a symbol like Microsoft in the upper left, it's not going to work on this chart. You got to click on the chart back on the charts tab to get back to your normal charts.
And Brent, we had a good question. We can do this too. There was a question about the yield curve.
Yeah.
And an easy way to do that, commonly, I think, Brent, the most commonly looked at yield curve is probably the 10-2 spread. And we can do that with something as simple as a slash 10y minus slash 2yy for the 2 year. And that gives you basically, they're up, right? So we have a positive yield curve as opposed to when we were inverted, but the level that we want to monitor is 0.
Yep. Zero would represent, total flatness between the two, no difference between the two, because we're looking at the difference between those two. And so we are positive a little bit, not hugely, but we are a little bit positive right now on that. And and yes, I think I agree with you, Kevin. That is the easiest way to find the yield curve, is if you can just remember that. You can find the yield curve on that economic data page as well if you want. If you go back to interest rates, and then there is an interest rate spreads one down there. It's right there. And if you click on that, the 10-2 is the very top one. If you click on that, that'll give you, again, you got to zoom way in because it goes way back there to see what we got in terms of that. But you can see how we've been inverted. We had been inverted for a couple of years really there, but we're still a little bit above zero. So anyway, that's probably enough enough there on the economic data front there, but just not, it's not, it's not, I can't speak for you, Kevin. It's not an area I go to a lot in terms of the webcasts that I teach, but it's something that you may find of value, I think.
Yeah, I agree. It's not something that I get to often. It's also an area that I just don't get to on my personal side of things because I'm too busy trading the things that I pay close attention to. But it's a great reminder of the depth and robust nature of Thinkorswim. If you've ever wondered what's available in this tool, all it takes is a few hours of clicking through every single link you can find. So hopefully everybody kind of found that to be a little bit helpful and a good reminder of what's available under Analyze and economic data specifically. Brent, one of the areas that I have been very displeased with of late is the semiconductors. And today we are getting finally a bit of a bounce, a nice 2.5% bounce after a real ugly day yesterday. I want to zoom in on this. The unfortunate thing that I'm bringing to the table today is as good a move as we're getting, up 2.4%. We haven't fixed anything here. I don't like either of these lines I've drawn. The white line as an uptrend line feels kind of dubious. The red line feels more important. We've been below it for more than 3 weeks, and we've tested it, failed at it, and been incapable of getting ourselves back above the 50-day moving average or back into that former triangle. So what are your thoughts as it relates to the semis here?
Well, keep looking at the white line, keep looking at the lows that we've hit over the past couple of weeks. Those are key levels. If we don't want to break those, because not only is that breaking the I guess the more generous support level that you've drawn, trend line that you've drawn, but then we're getting lower lows at that point. There's not much bullish about this right now, so I think a lot of traders, I don't think many, let me rephrase that. I don't think many bullish traders would see a lot to see in this chart right now. we're below the 50-day, we're below the 200-day. We are barely below, we're barely above that 20-day, but that 20-day has been trending down. So yeah, not seeing a lot right now. And you can see that reflected in that RSI, by the way, at the bottom of the chart. Just, lower highs along the way. I don't know if that's going to change, but that's what we have.
Yeah, if we were looking for a shift, Brent, something from a confirmatory standpoint that traders of the semiconductor index here might look for would be a move that gets them to a new short-term high. Let's say takes out the high we made about, what was that, about a week ago? Takes out that high and shows the RSI trading through this last peak as well. That might be maybe that inkling that things are improving enough for the semis that people would start to get a little more confident or comfortable in the short term. But that would be just a singular piece of possibly confirmatory data from the charts viewpoint, at least, that some traders might look for. Even price action on a closing basis that got you above the 50-day for a day or two, but didn't bring the RSI to new short-term levels, new short-term highs, that might be questionable as to whether it can stick. So, again, none of this data is certain, as you all know. I'm going to continue to point out, we never speak about certainties. We speak about probabilities. That's the best way that we can really learn to manage things, right? And so when you're thinking about probabilities, think about comfort. Is it more likely to happen now? Is it less likely to happen given the price action? And then just utilize that to help you maintain your individual positions and your approach to the portfolios. So, okay, big move, good move. We're happy with what we're getting out of the semis today. Brent, the one thing that you asked me to put a pin in a little bit earlier, we were talking about rates, we were talking about mortgages, but the home builders, today, yesterday we had a couple of downgrades in the space. Today we've had a couple of downgrades in the space as well. And I thought we could do this here quickly. Let me put up the Homebuilder indice here. This is, here we go, sitting at major support. Now this group has done very, very well collectively. If we go back to a weekly here, Brent, I mean, just looking to the lows in the late fall or the early fall of 2022, so about a 2-year push, we have been seeing home builders do very, very well. Now, again, this is home construction specifically, and we are at an area of major support. But the news we got today was from Barclays in regard to the home building space specifically, and they have downgraded 4 major builders. They downgraded KB Homes, they downgraded DR Horton, downgraded Lennar, and downgraded Pulte. And the commentary here, Brent, is key. The analysts at Barclays thinks that building products and distributors will outperform, with end markets being near a trough at this point, moving to the sidelines on home builder stocks as we enter 2025. They expect building products and distributors to outperform home builders and the market. For builders, their comment was that the 2 years of relative stock outperformance and an unprecedented market recovery that has occurred in spite of high rates and challenged affordability, believes that the new construction market has now hit a ceiling, according to Barclays. So I thought this was absolutely something to bring to the table and make note of today, Brent.
Yeah, it is interesting. So basically, home builders have rallied during a time when, there's actually some tougher conditions, almost in anticipation, if you will, of the better economic conditions. But even if a lot of people are forecasting slightly lower interest rates, they've already kind of made their run. Now, so Kevin, I have a question for you.
Go for it.
If Lennar and Pulte and DR Horton and all the ones that, at least in my mind, come to top of my mind, if they're the ones that are going to, are downgraded and expected to suffer from this and do poorly, what part in the home construction industry is there that isn't on this list that maybe we could take advantage of?
Well, I got to think that's in building products, right? I mean, as they stated, as Barclays pointed out, the thought process being materials might be the area within home construction that stands the best opportunity to gain. Because again, what we've seen has been a meteoric move over a 2-year window in the end space, right? The end being the actual deliverance of these homes to buyers. So if, for example, we witness material costs increasing, thought process could be that benefits the sellers of such materials, but hinders the users of such materials as well. So Brent, what do you think? Do we go into something like the material space specifically, which would give us maybe a watch list for that, or something else? I mean, I was thinking materials, but what about you?
Yeah, I think we look at materials, and then of course, it's just like anything. I think it's you don't take an analyst report or something, and it's not like, oh, I'm just going to take that to the bank and forget thinking about it and not look at the charts anymore. We're going to continue to look at the charts and find companies that look good technically that also fit into our thesis. And if that's the case and it looks good, if it fits into our thesis, but it doesn't look good technically, we're still going to say no to that. So what we'd like to do is we'd like to see both in that case, and find companies and be open to the fact that maybe we're wrong, right? That happens all the time. Sometimes, no matter what I think a chart should be doing, the chart is not doing that. Instead, it does its own thing. So you got to pay attention ultimately to the chart.
Yeah, I agree. And I just want to give you all the steps that I've used here to locate this group. We went to Market Watch. We then went to Industry Group in the drop down here. So by industry, select going into materials. I'm just hovering, by the way, here, everybody. So we open up the tree, so to speak, the various branches of the industries and sub-industry groups. We could sort by all materials, or we can go down in strictly to construction materials. And that's where I was leaning today, specifically based on this commentary out of Barclays. And so selecting construction materials and then looking at something like year-to-date percent change. If you're looking for leadership, you can sort by that. I've got the 21-day relative strength or 89-day relative strength as opportunities as well. But this could be a starting spot for you. Now, not every stock in the space is going to be valid necessarily, but we might just simply create a watch list from here and just make this real simple on ourselves. Let me see if I can bring this over here. There we go. So let's just do, construction materials. And this will give us something to keep an eye on, and then I can place it over here for a watch list. So I'll just go into my personals, construction materials that I just saved. There we go. And so this is not a dynamic watch list, right? But it is going to be that not hold the way I'd hoped.
Huh.
Well, if push comes to shove, Brent, I can always just make it like so, the construction materials drop down, right?
You got that there.
And then I can,
one other thing I would add on that is you can, that's a great, absolutely great. And that's just standard procedure. Make sure, not just for what we're talking about right now, but in the future, that's how you can create these. Sometimes on these kind of all-encompassing watch lists, you get some really thinly traded stocks on there too.
You do.
And so you could also put on a filter for market cap or something like that on there. You could add in a column on the watch list for market cap, or if you create it in a scan, you can also just add that as a filter. And then when you save it as a dynamic watch list, then you can kind of see what some of the reasonably sized companies are on that list there.
Yeah, that's a good point. We could totally add that in market cap. And again, lots and lots of alternatives from which to select in here, everybody. But market cap is a good way to do that and to give you a sort availability, right? Now you could sort by the largest or sort by the smallest. And so some of us don't like all the NA. And because I've got a little bit of an OCD issue, I might go through and just build the list out and eliminate all the NAs and then resave it so that I don't have those pointing to, in my watch list at all. But that's just a decent reminder. So again, this doesn't mean that Barclays is right, but I found it notable because of the two downgrades we got yesterday in the same space, and then a slew of downgrades today in the same space. And once more, when we looked at where the space itself, home construction, collectively is at, it's at a major zone of support. I mean,
Yeah.
this is done very, very well. But at some point, the input costs might prove to be problematic, and we've already seen how difficult things can be in a short-term window when we start balancing inventory against rates. That can prove to be difficult at various windows of time. So when we're at areas of import, it becomes important to keep an eye on them, Brent.
Yeah, and that's a key area there. That support level you have highlighted right on the chart. In fact, it happens to coincide with the 200-day moving average too, which is, I mean, that was there regardless of that moving average, but that is a key level we're at. So we'll keep an eye on that.
Yes, we will. All right, Brent, let's see. We've got about 8 or 9 minutes to go, and we do have some other stocks in the news this morning. So let me pull up my details here. Yesterday, I always love it when this occurs, Brent. I had a note yesterday that Travelers was upgraded, pardon me, and they pulled back pretty grossly. Unfortunately, it was not a great day as we broke the 50-day moving average, even though it got upgraded yesterday by HSBC, was upgraded to buy from hold, and a new target at 290. And then today, Wells Fargo takes the other view, downgrading Travelers to underweight, formerly at equal weight. New price target here at 217, down from 256. The firm sees potential further general liability reserve additions, tougher margin comparisons in 2025, and overall cautiousness within the commercial lines space, given elevated loss cost trends. So views Travelers shares as more than fully valued, and the company should see margin and reserve volatility in 2025. That doesn't read favorably, and honestly, the drop we've made here has not been terribly small. It's almost 10%, Brent, off this double top I see up here.
Yeah, that is a significant drop. It's also right at a support level, right there where we hit our highs, we gapped off those highs, we came down, we retested it back in like late October, maybe something like that. That's where we are right now, and so the next day or two will probably tell us a lot on this.
Yeah, I think so too. And the other thing that stands out, I know this is always tricky, Brent, because you're getting the RSI leading you into oversold conditions, and yet you're sitting at a major zone of support. And this becomes that balance, doesn't it, between do I pay attention to the price action or the tertiary, criteria of an indicator like the RSI? I think a lot of traders would prefer to lean into price. And so, we are sitting at major support. But I often say, Brent, you don't have to be a buyer the second you get to what you've defined as support. Many traders like to let that stuff settle out over the course of 2, 3, 5 sessions to validate an area of support before being willing to step in.
Yes. And so I would agree. I think indicators, oscillators, like the RSI or MACD or stochastic or whatever can be very helpful aids. They don't supersede the price action on the chart, though. The price is king is kind of how we say it.
Yeah, we are prone to suggesting price is king. That is what matters. Let's try not to read too much into the tea leaves, right? We want to pay attention to that. To price more than anything else. Let's see, Brent. We also had a downgrade in General Dynamics that I thought we could check out. So let's hit up GD real quick. In which this one falls under the guidelines for me, Brent. Of hey, this is a great note from Wolf Research downgrading General Dynamics to peer perform from outperform. They did not provide a price target. The firm citing estimate cuts. The firm cites that its estimate cuts the absence of any noticeable improvement in their G700 deliveries and continued marine unit performance for the downgrade. So I found that's great. Thanks for the heads up. Appreciate it. Why didn't we talk about it 3 weeks ago, Brent?
It is interesting. So this is well, one of these companies that you think of as a defense contractor,
Right.
And I don't know. Maybe this would tend to perform better with geopolitical risks, and maybe people are seeing that element of things subsiding. But from a technical standpoint, which we often preach here, we're not just below that 20-day moving average. We're well below that 20-day moving average. That's a strong sell-off we've had here in General Dynamics right now, with no sign of any. When you're looking at stock that's falling, and maybe the most bullish thing I could say about it is it's actually in the oversold area. It's gone down so much. Maybe it's time to bounce back. That's maybe it's overextended. That's not a good sign in terms of its bullishness there. It's just I see nothing bullish about this right now at all.
The worst of it is, Brent, I'm sure there's a headline in here somewhere that probably speaks to the big move we made. I put up the earnings detail to see if it was an earnings move. And I'd venture to guess it, what is that? What is the date here? This is middle of November, right around the 14th. So maybe a headline that I missed at the time. Yeah, defense stocks taking it on the chin. This is all about, okay, this looks like it's all about with the process happening overseas, essentially, right? The concerns around the potential for more strife, if you will. The pullback, though, aggressive in nature, Brent. And we don't like that, obviously. And you're right, counter trend could be opportunity into or in the vicinity of the 20-day. But Brent, not a lot of traders like to do counter trend trading. It proves to be pretty difficult more than a few times here, Brent. That's for sure.
Yeah, I was looking to see if that drop kind of coincided with election results, but it didn't there, at least immediately. So, yeah, so I guess we'll see. But right now, bearish.
Yeah, I was just going to say, I'm still flipping through all these headlines, and it was General Dynamics down 5%, on pace for the largest decrease since 2022 March. And no comments other than just the price action. So this one is difficult to look at because I was just looking for anything that could have been a heads up for us, and I don't have a lot, Brent. Even the RSI wasn't. It was at a slightly lower high than we made back here, but this is the epitome, if I'm not mistaken, of a fake out breakout, right? You got it for 3 days even. You even got to the level of the so-called Horner rule, holding the breakout for 3 days, and then it just cratered and then continued the crater, unfortunately. This has been downright ugly. My goodness. Just to give you an idea of
and so, it just reiterates what we've been saying, and that is you trade the chart, not what your perception of what something should be doing there. And Kevin, let me just point out something.
Yes,
There's
please.
a survey link in the chat as well. So we do encourage you all to give us some feedback here. We appreciate you watching the webcast, and if you'd fill that survey out, we'd love it.
We would. Survey details are very helpful for us, everybody. That comes to us directly. We get the opportunity to review your comments, your requests as well. Those are things that we will work to get to for you, in subsequent classes. But that's your best, really good shot, at least, at not just sharing it with Brent and me, but with our leaders as well, so that is part of the pipeline. So, because if it's something that's coming to just Brent and me, we could miss it, could forget about it. But a great reminder that our leadership is looking at this stuff too, and they want to make sure that we're providing what we can that y'all are looking for. So thanks for reposting that in there, JB. Brent, I think we should wrap it here. We pretty much covered everything we had on the list today. We could certainly, if we had more time, we could roll through many, many, many more charts, but there is always more to come for you all here on the Schwab YouTube coaching channel. So make sure you're checking out the calendar. Brent, as always, love having you on a Wednesday. Thanks for sharing your thoughts and your insights, in particular, the look at that Analyze tab that helped us out today on rates. That was very helpful.
Thanks for having me on, Kevin. As usual, enjoy my Wednesdays with you. And everybody have a wonderful rest of the day.
Yeah, do that, everybody. Enjoy the rest of your Wednesday. I'll be back a little later, 1 p.m. Eastern, for trading breakouts. If you'd like to join for that, love to see you there. But hope you all have a great day, everybody. We look forward to seeing you again soon.